All right, today we're slicing into Flowers Foods' third quarter 2025 earnings. Now, on the surface, sure, it's a bread company. But if you look under the wrapper, there is a major transformation going on. So the big question is their strategy actually rising to the occasion? Let's find out.
So let's just jump right into the weird part, because the market's reaction here was pretty fascinating. The results, well, they weren't spectacular by any means. But after an initial dip, the stock actually started climbing. And that tells you everything you need to know. The real story isn't in the headline numbers. It's about what investors were expecting and what they found hiding between the lines.
Okay, so the big number everyone was watching, adjusted earnings per share, and that came in at 23 cents.
And that 23 cents was exactly what Wall Street had penciled in. After some recent guidance cuts and a lot of nervousness, just meeting expectations, that was seen as a win. No negative surprises here basically meant a collective sigh of relief from the market.
Now, let's look at the top line. Quarterly revenue landed at just over $1.2 billion. That's a 3% increase over the same time last year.
But what's really interesting here is that this number was actually a small miss. So why didn't the market care? Well, expectations were just incredibly low. I mean, the whole packaged food space is getting hammered right now. Consumers are tired of inflation and they're changing how they shop. So given that brutal environment, the market pretty much shrugged this off. The real story is how they got to that number.
So let's pop the hood and dig into those drivers, because the composition of that revenue growth, it reveals absolutely everything about the company's strategy and its biggest challenges.
Okay, check this out. That 3% year-over-year sales growth was entirely, and I mean 100%, driven by their big acquisition of the snack maker Simple Mills. The core, legacy business, it actually saw negative pricing and a drop in volume. That is a serious headwind. It's a force that is actively dragging their main business down. And this slide right here perfectly illustrates their intentional pivot. You can see it clear as day. They're getting stronger where it really counts, in their high-margin branded products, while at the same time, they're strategically letting go of the lower-margin business, things like private label and food service. This is the absolute core of their transformation strategy.
And you know what? That focus on their powerhouse brands is really paying off. The overall bread category is shrinking, with units falling almost 3%. But look at Flowers' key brands. They're exploding. Dave's Killer Breads units are up a staggering 10%. Their sandwich buns are growing 7%, while the rest of the category is actually shrinking. This is undeniable proof that their strategy to go premium is working.
But here's the catch, and it's a big one. All that growth is expensive. Both their gross margin and their EBITDA margin took a pretty significant hit, falling 1.9 and 1.6 percentage points. So what's going on? It's a mix of things. Some of the new products have lower margins, costs are up, and the interest payments from that big acquisition are really starting to bite. It's squeezing their profitability hard.
So, the crucial point to take away here is this. You just can't look at this quarter in a vacuum. Flowers Foods is right in the messy middle of a complete and total strategic overhaul.
They are fundamentally trying to change their own identity. The goal is to get away from the traditional white bread aisle, which is in a slow structural decline, and become a modern food platform, one that's built on high-growth premium brands and the absolutely booming snack category.
And look, this isn't just talk. The huge cash acquisition of Simple Mills, that was basically the starting gun. They're continuing to innovate, and, this is critical, they're bringing in a new CFO in January who has a track record in these kinds of corporate transformations. He's there to manage the financial side of this very tricky pivot.
And managing the financials is absolutely key, because that Simple Mills deal pushed the company's net debt to EBITDA ratio to roughly 3.4 times. What does that mean? Well, it's basically a measure of how many years it would take the company to pay back all its debt using its current earnings. And trust me, anything over 3 is generally considered pretty high.
So this brings us to the single biggest risk and the question that is on every single investor's mind. With leverage that high and a dividend payout that is currently more than what they're earning, something has to give, right? Management keeps saying they're committed to the dividend, but the math is just getting really tight.
So let's put this all together. What does this mean for the stock, and what should we be watching for in the next earnings call?
The whole story is just perfectly balanced on a knife's edge. The bulls, they're going to point to the incredible brand strength and these really smart strategic moves. But the bears, they're going to point to that declining core category, the severe margin pressure, and that very risky balance sheet.
For us, that powerful bull case is being completely offset by the very real risks of the bear case. The potential for strategic success is there, but it's balanced by the potential for financial distress. And for that reason, we're initiating our coverage with a market perform rating.
This quote really captures the dynamic perfectly. They are successfully running up the down escalator. Their brand wins are real, they are impressive. But they're fighting against some powerful structural forces. For the next quarter, we're going to be laser focused on two things: any sign that margins are starting to stabilize, and any concrete progress on paying down that debt.
And of course, please remember, this analysis is for informational purposes only. It is not financial advice.